Hello everyone, welcome back to Fundrise Finance. It has been a brutal past few days in the stock markets, with the S&P 500 falling almost 4% just today, that's Monday, June 13th. And over the last 5 days, it's down almost 9%. In 4 of the last 5 sessions, the S&P 500 has fallen more than a percent. And on Friday and today, that's Monday, June 13th, together the market has fallen more than 6%. These are just astounding. The Nasdaq has fared much worse. It's down more than 10% in just last 5 sessions. And the Dow Jones, slightly better, falling just over 7% over the past 5 sessions. If you look at the market graph, early part of last week was where the investors were still jittery, the market was going sideways, then what was the inflation numbers to be expected. But right when we went towards Thursday's session, towards I would say end of Thursday's trading session, that's where the market started really getting spooky, and it was just a mayhem from then. You can see from then till now, the market is down 8.5%. So the most damage in the last 5 sessions has just been in the last 2 sessions, actually. And we all know the reason for that. It's because of the inflation numbers that came out on Friday, where it rose 8.6% in the month of May, the highest since 1981. It's like more than 40 years. And the major contributor to this inflation are the gasoline prices, where the national average is $5 a gallon. And no matter if you own an electric car or not, the rise in gas prices will impact you, because every company that is involved in goods and services has to make use of gas driven trucks to transport goods. And yes, they do try to absorb the prices as much as possible, but at the point when they cannot, they'll just pass on the prices to the customers. And that's where we see the grocery prices rising. In this chart, we can see almost across the board, every item in the grocery list is up. It includes beef, milk, eggs, everything that we consume in our day-to-day lives. So yes, the inflation hitting record numbers was not actually a surprise, because everyone was seeing increase in prices across the board, but it just market behaves the way it behaves. Here we can see the S&P 500 heat map, almost red across the board. Not even the energy companies were left today, even those were decimated. It has been a bloodbath in the market over the last 2 sessions. If we look at the last 1 week data, we can see even the biggest of the biggest companies like Microsoft, Apple, Google, all falling almost 10%. Amazon is like 17% down. These numbers are just mind-boggling. With today's decline, the S&P 500 is officially in a bear market territory. That's what even the S&P Dow Jones indices have confirmed, that the market is down more than 20% from its recent high, which the market hit on the Jan 3rd. So from then till now, the market is down almost 22%. The Nasdaq was in the bear market territory for long already, but today it just got pushed way beyond the 30% mark. So as we see here, year to date, the Nasdaq is down almost 32%. The Dow Jones is just hanging on to its correction territory right now. You never know, even these Dow Jones stocks could just get pushed out into the bear market territory. What I wanted to do with this video is actually compare my portfolio and see how it has done compared to the broader market. So this is my M1 Finance portfolio. It's almost $17,500 now. Overall, I am in the red. It's more than 14% loss already. The market gain is the negative, almost $2,300. The dividends have been a saving grace over here, almost $571 of dividends till date. In the last 1 week, though, my portfolio has fallen 7.64%. So when I compare that to the S&P 500, which has fallen 9.02% in the last 5 days, I should say my portfolio has actually held better. Of course, it doesn't give me any comfort in saying that my portfolio has gone down, but still it just gives me a little bit of satisfaction that my portfolio has held better compared to the S&P 500. So let's see which of the pies in my M1 portfolio have done better or worse in the last 1 week. Starting with consumer staples, which has done the best at 5.38% down. Here, Coca-Cola has been the best, down 2.44. Kimberly Clark, almost 3% down. PepsiCo 3.5% down, Costco down 4.28, Walmart down 4.37, and Altria Group down almost 12%. Then comes the communication sector, which is down 5.45%. Here, Verizon has done the best of the lot, down 3.22. Then Comcast down almost 5%, AT&T down 5.64, and Omnicom down 8.35. Then I have the dividend income pie, which is a collection of dividend-based ETFs. This pie was down 5.73% over the past 1 week. Here, RYLD has done the better. This is the Russell 2000 covered call ETF, down 3.55%. Then XYLD down 3.64% and QYLD down 4.26%. In fact, I'm a little surprised by the performance of the covered call ETFs because if we compare, let's say, RYLD with IWM, which is the Russell 2000 ETF, we can see that RYLD is down less than 4% for the last 5 days, whereas IWM is down more than 10% for the week. Similarly, XYLD, which is down less than 4% for the week, and if I compare that with VOO, which is the S&P 500 ETF, it was down almost 10% for the week. Likewise, QYLD, when I compare that against the QQQ, QYLD is down less than 5%, whereas QQQ is down almost 11%. So yeah, these covered call ETFs have actually surprised last week, I would say, compared to their regular counterparts. In Devo is down 6.1%, JP is down 6.25%, and SCHD surprisingly is down 7.1%. After that, we have the healthcare pie, which is down 5.85%. Here, J&J has held the best, down 3.17. AbbVie almost 5% down. Merck 5.37 down. Medtronic negative 5.54. Walgreens negative 7.16. And Pfizer down just more than 10%. Then you have industrials down almost 6% for the week. Here, Watsco has done the best, down 3.11. Then L3 Harris down 3.26. Then Lockheed Martin down 4.4. And 3M down 6.73. Caterpillar down 7.49. Union Pacific down 7.6. UPS down 7.7. And Cummins down 7.74. So yes, even the industrial sector was clobbered. And from here we see the pies which have been decimated more and more, starting with consumer discretionary down 6.5%. Here Tractor Supply held the best, down 3.54, and McDonald's down 3.87, Genuine Parts down 5.76, Leggett& Platt just over 7% down, Target down 9.3. Target has just been facing more and more issues over the past few weeks, and Whirlpool over 10% down for the week. So yeah, consumer discretionary just getting hit hard. Then we have the ever stable utilities, which is down 7.28 for the week. Here we have Black Hills Corporation down 7%, Consolidated Edison similarly down 7%, UGI Corp down 7.25. Then the utilities ETF, the worst, almost 9% down for the week. And even the utility sector was not spared. Utility companies are those which don't rise much, which they don't fall much, are like stable dividend paying companies, but in this market, they are not being left out. Then we have energy sector, which is down almost 8% for the last 5 days. The energy ETF has held the best here, down 6.23. Then Enbridge down 6.6, Kinder Morgan down 8.39, and OneOp down 9%. If you look at the year-to-date chart for the XLE, which is the energy ETF, we can see it's like 47% for the year. But when we look at the last 5 days, we can see it took a massive hit from Thursday onwards, down almost 6%. And that's what reflects in my portfolio also. And then there's the real estate sector, down 8.4%. Here, WP Carrier has held the best, down 1.9. Realty income down 5.6. Digital realty down 5.7. Medical properties down more than 11%. Vici, which just got added to the S&P 500 last week, had a terrible start, I would say, down almost 12%. And then Arbor Realty down 13.5%. And then I have my Vanguard ETF pie, which is a collection of Vanguard ETFs that make up the whole US and the international market. So this is my 80-20 division between 80% of US and 20% of international. Here, my two international ETFs have held the best. The VIGI, which is the international dividend ETF, down 6.9, and VYMI down 7.53. And after that, we have the value ETF, VTV, down 7.57. Then the S&P 500 ETF, WOO, down almost 9%. Then VBR, which is a small cap value, down 9.85. Then real estate, VNQ, down 10.17. And the growth ETF, VUG, down 10.58. And then there's technology, it's down 9.7%. Here, Cisco has done the best, down 4.6. Then Broadcom down 7.77. Qualcomm down 8.39. Texas Instruments down 8.48. Oracle Corp down 12.22 and HP Inc. down 14%. Oracle announced its results after bell today and they seem to be better and it got a nice bump afterwards. We can see here it's almost 15% bump after the market was closed. So tomorrow when the market opens, I should see at least Oracle recovering a little. Then we have financials down 11.42%. Here Prudential down 10.5, JP Morgan 10.6, Citigroup down 11.11, BlackRock down 11.34, Morgan Stanley down 11.41, Bank of America down 11.4, Goldman Sachs down 11.6, and T. Rowe Price down almost 14%. These are like shocking, shocking financial numbers. Each one of them has fallen more than 10% for the week. Then at the last, I have the materials sector, which is down 12.17, the worst among all. Here, air products and chemicals held the best, down 5.7. Then Nucor down 13.29. Sherwin-Williams down 13.5 and Louisiana Pacific just got clobbered down almost 18.5% for the week. Overall, when I look at my finance portfolio, just for today, it has fallen 3.54%. The dividend yield has been rising because the portfolio value has been going down. So currently it is yielding 4.11%. And barely a week ago, I know the yield was 3.74%. So the markets being so much volatile in the near future, what do I plan to do? I will keep investing into companies which are at really good valuations. In fact, I do post videos at the beginning and in the middle of the month regarding the companies which I feel are at the best valuations at the moment. And just as I keep telling others, I do the same. I keep investing into them no matter whether the market is up or down because consistency is very important for a dividend investor. And if you get to buy companies at very cheap evaluations, that's really good. You get to increase your yield on cost because the markets will rebound at some time. And markets like these give opportunities to buy companies at very good valuations. So that's all I have in this video. I hope you liked it. And until we meet our next one, let's try as much as possible to be financially healthy. See ya. Bye.